Welcome back to Dave's Market Explorer. Today we're diving into one of the boldest calls on Wall Street right now. Fundstrat's Tom Lee says after some near-term turbulence and the new Fed chair gets tested, we are about to enter the best 18 to 24 months the stock market has ever seen. Let's explore whether this has real substance, using cycles, waves, history, and time. First, the setup. Tom Lee expects 2026 to be tricky. Possible 10 to 20% drawdown as the new Fed chair Kevin Warsh gets tested by the market. History strongly supports this idea. Since 1930, when a new Fed chair takes office, the S&P 500 has seen average maximum drawdowns of 16% in the first 6 months and up to 20% in the first year. 10 out of 13 previous chairs faced at least a 10% decline early on. This isn't a bug, it's the market testing the new leadership. Once that test is complete and policy clarity arrives, the real move higher begins. That's exactly where Tom Lee sees the 18to 24-month golden window starting late 2026 into 2027-2028. Next, the presidential cycle. 2026 is a year 2 under a sitting president, historically the weakest year, averaging around 4% returns. But look what happens after midterms. The one-year period following midterms has averaged 15.4% gain since 1950. That lines up perfectly with Lee's timeline. Technical structure also supports this. Most Elliott Wave analysts see the recent action as a corrective wave inside a larger bull market that began in 2022 or 2025. The wave count suggests we still have a strong impulse wave ahead, potentially pushing the S&P towards 7,300 to 7,700 as Lee targets. Longer cycles add even more weight. 2026 lines up with a convergence of the 4-year presidential cycle low and a larger 60-year Gann-style cycle low. These convergence points have often marked major volatility troughs followed by powerful multi-year advances. And we're still in a secular bull market. Post-war secular bulls have lasted about 19 years on average and delivered over 450% total returns. With AI productivity gains, millennial wealth transfer peaking, and global capital flowing into US growth assets, this bull still has plenty of room to run. History shows that the strongest 18to 24-month stretches in the stock market almost always follow periods of uncertainty, Fed transitions, elections, corrections. Once those resolve, earnings growth, retail inflows, and multiple expansion take over. Tom Lee believes all three catalysts are lining up. So is Tom Lee right? The historical cycles, presidential patterns, technical waves, and secular backdrop all give his call real substance. The next 18 to 24 months could indeed be some of the best we've ever seen, but only after we get through the test. Drop your thoughts below. Are you positioning for the test, or already looking past it? Like, subscribe, and hit the bell for more cycle-based market exploration. This is Dave's Market Explorer, seeing the bigger picture through the noise.